Hey traders, it's Rachel here for your option of the day for May 3rd. For today's trade, we're looking at a covered call strategy on medical leader AstraZeneca. So looking at AZN on MarketSmith, shares are currently trading in a 5% buy zone from a flat base with a 72.22 buy point. Shares have been trading in this buy zone for nearly a month now following the breakout on April 5th. The stock nearly became extended at one point but has been drifting sideways for the most part. Earnings reported on April 27th did little to help or hinder the stock. Shares continue to hold support above their 21-day line. Earnings growth for the stock has been shaky in recent quarters, showing a decline in the quarter before last and only a 3% increase in the most recent period. Since the start of 2023, shares have had a decent rally, up over 16%, compared to a drop of over 1% in the S&P 500 during that same period. This stock currently pays a dividend of 1.9% annualized, but with today's covered call strategy, investors can enhance that yield on this stock. This is a good place for beginners to start with options. A covered call is designed to collect income while also defining a predetermined exit price at which you'd sell the underlying stock. Say you buy 100 shares of a stock. Covered calls can allow you to lower the cost basis of the long position via selling call options against your position. As the seller of the call option, you're obligated to hand over your shares to the call buyer at the agreed upon price or the strike price if shares trade above this price at the expiration date. In exchange for this, the buyer of the contract pays you a premium. Any appreciation in that stock above that strike price represents a profit for the call buyer. But if the stock instead declines in value, the buyer would have no reason to exercise the right to buy it for a higher cost. In this case, they'd likely just allow the contract to expire and lose the premium paid. So with all of that said, let's take a look at my trading platform and set up a trade using AZN. Buying 100 shares of AZN would cost around $7,370. In addition, a June 16th expiring 75 call option can currently be sold for around $1.90. This would generate $190 in premium per contract and enhance the annualized yield. If AZN closes above 75 on the expiration date, the shares will be called away at that strike price. The risk to the downside with this trade is that AZN might drop, which could wipe out any gains made from selling the call. Covered calls are a fantastic way to generate extra income from a stock holding while providing some downside protection. Investors would need to weigh the pros and cons of the stock, though, before initiating the trade. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment in some cases. Check out the new Options Trader app from IBD for more digestible options education and some great trade ideas. And be sure to join us for our regular content here where we break down a new trade idea every day.